All right, so the ICT institutional order flow entry drill. On the left-hand side, this is when the market is bearish. And then we have another gap right here. If we trade up into that, this is a balanced price range. Institutional order flow entry drill would be expected in this instance for sell. In other words, not likely to see it completely fill in. When the market's bullish, same thing here. The market went down, created some short-term low. We don't care about the low. We're just watching the market go higher again, where we have a gap over here and another gap matching it like that. That's a balanced price range. If it trades back down into that, great below or at that candle's low, that's a buy for institutional order flow. That's when you would expect to see it when this balanced range formation occurs. Another instance is when we're expecting bullish prices and you see the market create a short-term swing high and then trades down and creates a short-term low. And again, that triangle area is just, I'm trying to keep your attention on the areas that constitute a institutional order flow entry drill. I don't want to have extra candles up here to this swing high. I don't want to show you any number of candles that go down to create some kind of short-term low. That is the variables that can be all kinds of different examples of what that would look like. But when we're looking at when the market's bullish and we had a recent swing high that's traded through, and then we have a gap here, okay? If we trade back down into this gap to this candle's low or below it by a little bit, but not closing in, that makes it institutional order flow entry drill. Why should that be expected when it has this swing high in here? This candle has a wick on it, so consequent encroachment. That should be supporting price too. That also makes a case that this shouldn't completely close in on this candle's high here. So institutional order flow entry drill would be expected bullish buy at that candle's low or just below it, not closing in this entire imbalance because of the old high here. So the idea is the market's bullish. It rallied from some level down here. We don't care. That's not important. See, most of the things that you guys do when you're training with me and looking at charts, you're looking at way more chart candlesticks than you need to be. Looking at candlesticks and you're looking at way more than you should be, it's going to be difficult for you to learn because you're trying to take in more information that's not necessary. So my idea here is that we're bullish. The market's shown a willingness to want to rally. How many candles did it go up? Or how many periods did it go up before it creates this swing high? It's irrelevant. Okay? Once it creates this swing high and it trades back down to some swing low, how low does it go before it makes that swing low? It's irrelevant. Okay? Once we trade through this swing high and it's rallying and we have a gap here, this gap is not a fair value gap because it has this wick in it. So this range high to the close, or I'm sorry, the open of this candle, that wick, midpoint is consequent encroachment. If you extend it out in time, that's right here. So this next candle or some candle in the future, if it trades down to that candle's low or below it, we would not reasonably expect to see this range completely close in, which makes it institutional order flow entry drill. Why does it not want to likely close? Because this candle's wick is a gap and it acts the same way that a balanced price range would be, because on the previous one, see how we have this? This is a gap and this is a gap. So we have gap up, gap down, both balancing this area. Buy side delivery, sell side delivery. Okay, so if it's going to gap through and then gap down back through it, that's a balanced price range. It does not mean it can't come back up into it completely and close it in and go deeper against your institutional order flow entry drill entry. That's always likely. It's not highly probable, but it's likely. So that's why your stop isn't just, oh, let's put a stop right here at the top of that and call it even. No, your stop would have to be above this candle. Okay, or maybe even using the opening. The body of that candle would protect below all this area here. Could eventually rather close that in. That's the one caveat to this pattern. So when you're using institutional order flow entry drill, you have to use proper stop management and allow for a little bit more of a drawdown. Whereas when we talk about fair value gaps, you can be a little bit more specific and precise about where your stops are, and they can be smaller. Institutional order flow entry drill, you're going to see a lot more entries and opportunities using this pattern than fair value gap. Fair value gap, When they're there, they're nice, but they themselves don't always have to fill in completely too. So there's some caveats with that as well, and we'll get into that one. But the difference is we have this gap here and the gap down here. This same gap is being illustrated with this. That's how I teach the wicks and the tails on the candlesticks. They are gaps because the market's opening on this candle, running up hypothetically, because I made this candle myself. It opens, rallies up. Right in there, that's a gap. The market runs for liquidity and then gives up that entire range and goes lower. So from the opening price to the high, that is a gap. And if that overlaps with this gap over here, this makes this a candidate for institutional order flow entry drill as a buy. If it touches that candle's low right there, the very next candle or some candle in the future, it doesn't matter. How much time? Why do you think you learned about the data ranges? The look back and the cast forward. So you have 20, 40, and 60. Those ranges could eventually be used for that to come back and trade back into it. Now, if you're using lower time frame charts, you're probably not going to be anticipating a 1 minute or a 5 minute chart 60 days later trading back down to it. Likelihood is probably the same day or same trading session. It'll trade back down into that and give you an opportunity to run with it if the market is indeed bullish. Opposite is seen with institutional order flow. When it's bearish, the market is likely to go lower. It creates a short-term low, rallies up to some short-term high or intermediate-term high. How far? How long did it take to get there? It doesn't matter. This is just indicating that it created some kind of a high between this period and this period here in price action. So if we see the market trading lower off of a short-term high or an intermediate-term high, and it's trading lower and it creates a gap here, and that overlaps rather with a candlestick's tail like that. This is a gap. Consequent encroachment would be right here, extend that out in time. The market, if it trades up to this candlestick here high or a little bit above it, you could sell short there. That would be your entry pattern, getting short with institutional order flow entry drill, with the expectation that it would not likely completely close in this gap because we are up against this over here. So to the left of these gaps, the classification for institutional order flow entry drill versus the common fair value gap, this is the characteristics I'm looking for to differentiate it and how I would trade them respectively. So if this were not the case, okay, and this was not having the gap shown with this candlestick's tail, this would probably be a fair value gap. But because it has this like this, if it trades up to this candlestick's high or just above it, I would look to go short, and the stop would be at that candle's open or this high here. And I would use that as my defined range. And how you know if you should be taking that entry, because you don't just look at it and say, oh, I'm going to get short here, put my stop loss and see what happens. You don't want that. You want to see, okay, if you're getting in at this candlestick's high on institutional order flow entry drill, and your stop is this opening, how many pips or handles, if you're trading indices, how much of a range is that? And does it offer you, from that point of entry, 3, 5, or more? Then you're forcing yourself to execute in high probability conditions. Reading the tape, you're studying. Does the moves consistently come like I outline them, how I teach them? If you see this setup here, where you're trying to go short, assuming that's the case, and you're using institutional order flow entry drill as your means of entry, your stop has to be on this candle here, the open or the high. Now, if this is a bullish candle, you would use the close or the high. But you want to be above the body's volume. You don't want to be anywhere near the inside here because, again, institutional order flow entry drill can sometimes expand up to and close in and retap that same level there. And if your stop loss is in close proximity to that, it'll take you out of it. And then it's just very demoralizing to see it come and start running in your favor. And you probably won't want to get back into it. And it's probably better that you didn't because you don't want to chase in price. But if you can find a opportunity like this and you frame that risk from where you try to get in at where your stop loss should be, and you gravitate towards working with a lot of setups, practicing and reading the tape with 1-to-1, then trying to force 1-to-2 as the only objectives for your studies, and then try to force only 3-to-1. And what do I mean by that? If this is, say, 20 pips of risk, try to find setups that allow for, if it does this setup as an entry and you're bearish, you're risking 20. Does this move have the opportunity to pay out 60 pips lower from your entry? And that will be 3-to-1 gearing. And that gearing is like really good, because with 3-to-1, you can weather a lot of mistakes. And eventually, if you can transition to only looking for setups that offer 5-to-1, then you have really matured as a technical analyst and a trader, because you know what you're looking for. You know how to frame it. 5-to-1, man, that pays for a lot of errors. And if you're controlled and you're responsible with yourself, you're not over trading, the gambling aspect of it, you're looking for transactions that make sense. And now you are incorporating 5-to-1 with it. Well, man, now you're well-rounded because you have a lot of experience behind you. And let's just say the trade works out that it doesn't really yield 5-to-1, even though you framed it in a way where 5-to-1 is what you're looking for. You're taking partials along the way. So if you take partials off at 2-to-1, and then again off at 3-to-1, and one off at 4-to-1, and you hold for the balance at 5-to-1, are you really technically getting 5-to-1? No. But are you adding to your balance and your bottom line? Yes. And you're managing fear and greed and your emotions. An additional homework assignment and study that would amplify this, you want to be looking at these in the kill zones, but then look for times where they are not forming inside of areas that are not kill zone. And you'll see that they're not likely to deliver like this, which is why I teach you kill zones. Okay?